Money FM 89.3. Best of breakfast. The bigger picture, only on Money FM 89.3.
Good morning. Welcome to the bigger picture. And we are looking at the latest inflation numbers out of the US overnight. And that's where the CPI numbers, or the Consumer Price Index numbers, came in hotter than expected. That weighed on Wall Street last night, and it is keeping investors cautious as the Asian markets unfold. So looking at those numbers, we had a reading for January coming in at 0.5%, which pushes the annual inflation rate to 3%. So a touch higher than December, which now leaves rates perhaps higher for longer. So let's check in now with Maurice Meijers. He's the Client Portfolio Manager for Fixed Income at Robeco. Good morning, Maurice. How are you doing today?
Good morning. I'm doing very fine. Thank you very much.
All right. So you keep your eye quite closely on where rates are going and looking at latest inflation data out from the US. What are your takeaways? What does this mean for rate expectations going into the rest of the year?
Well, you already captured it quite nicely. This does point to rates staying higher for longer. And I think that's going to be quite interesting because if you look at financial markets over the last few quarters, part of the rally, part of the bullishness was very much built on the expectation of significant rate cuts. Well, if those cannot be delivered, we should expect at least somewhat more volatility, maybe a bit of a correction here and there. So it's definitely quite material. Even though I would argue with just one number in January, maybe it's a bit too early to jump to conclusions. But it's definitely something that is quite meaningful for fixed income, but potentially also for other asset classes.
Okay, let's take a look at where the 10-year Treasury yield is right now for bonds, the U.S. bonds, now at 4.65%. And this right now is continuing to rebound from its 7-week low of 4.4%, which was sometime 2 weeks ago. So looking at where rates are going to be, we talk about higher for longer. So how high or how long do you expect this to play out?
Yeah, we should also not forget that not that long ago we were actually flirting with the 5% point. So that's only towards the end of last year that rates were that high. So they've come off quite significantly, now rebounding a little bit. Higher for longer to us would mean that indeed we remain in that kind of range, 4.5%, 5%. But it's also very much a statement about higher for longer in terms of Fed funds, so that it will have implications for how much the Fed can deliver in terms of rate cuts. And I think that is ultimately what the market is really focusing on at this moment in time. Can the Fed continue to cut rates as the market had been pricing in for quite some time?
Okay, we have markets pricing in a potential rate cut in September. That is now pushed back from sometime June, July from the latest data. Is that in line with expectations, a potential cut as early as September perhaps?
Well, so indeed, that is now still what the market is expecting. So no rate cuts in the first half of 25, and then potentially one or maybe two in the second half. It has been our expectation for some time now that even if inflation remains a little bit higher than its targets, at some point, the Fed will also start to focus much more on labor market conditions. The dual mandate of the Fed is not only inflation. There last week, that was the other number that we received very recently. The labor market is still doing fine. But as soon as we start to see some weakness, and we would not be surprised to see a bit of that going forward, also with the uncertainties around trade wars and tariffs, that could still open up, at least for the market, to continue to price in some rate cuts in the second half of 2025.
Yeah, lots of moving parts like you alluded to, and of course with the tariffs, that is continuing and developing conversation every day. All right, taking a look at what's on the table, how are investors expected, or what are you advising them to do in this market? What are the places to be gravitating or looking at more closely right now?
Yeah, so I particularly focus on fixed income and on credit markets. And we actually still find very attractive investments. And you could even argue, glass half full, with rates staying higher for longer, that also means that the carry available for fixed income investors remains attractive, at least for now. So you can still make a very decent yield on a bond portfolio of relatively high quality, 6-7%. To us, that is probably also what clients should be happy with at the moment. Last 2 years, one could make double-digit returns in fixed income. Maybe that is a bit overachieving for 25. But attractive carry, attractive income, that to us is still very advisable. Don't take too much risk on the credit side. Don't go into the lowest part, the quality spectrum, because there might be some refinancing risk if indeed rates remain quite high.
Yeah, when you look at bonds to buy, where do you look at and what sort of durations are you looking at?
Yeah, so definitely not too long on the duration spectrum, because that is where you're going to get the sensitivity, even for these kind of macro numbers. If the market starts to reprice Fed fund rates or other metrics, you will see quite some volatility in the long end of the curve. But if you just stick to 3, 5, 7 year bonds, really just for the carry, there's plenty to go for, and not just in the US, by the way. And we like to take a very global perspective. And if you look at it from a credit perspective, actually also Europe, but also emerging markets do offer some very compelling opportunities, because these markets typically are a little bit less expensive. And the US market, just like on the equity side, also credit markets in the US have started to become quite expensive. And it is a bit better elsewhere.
All right, great overview of where to look at when it comes to fixed income. We've been in conversation with Maurice Meijers. He's the client portfolio manager for fixed income at Robeco. Maurice, thanks for your time this morning.
Thank you very much.
Great chatting with you. Stay on Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.